When putting together a financial strategy, it's really exciting to talk about how to make money and create wealth for the future. Saying this, we really need to consider some of the risks. And today I was going to talk to you about personal risks. What happens if you pass away? What happens to your debts, your income for your family, etc. Or let's just say, for example, you don't pass away. Maybe you're disabled or really unwell, suffer from cancer or stroke or Parkinson's or one of those terrible illnesses. Or maybe it's not so heavy. Maybe it's something that you're just out of action for a few months, but you want to get back on deck and get back to work. What is the strategy in those situations? The good news is that we can take out insurance for pretty much those 4 events. So I thought I'd just step through the process and what each of those insurances do. So the first one is life insurance. Now, life insurance pays a lump sum, so one large amount. Now, when determining the amount that we insure for, generally that we think of 2 things. One is how much do we need to clear debt? For example, when people take out a mortgage, often they're doing it with a partner and the bank is assuming 2 incomes. Now, if one person passes away and there's only 1 income, in many cases that person can't generate enough money to basically clear the debt or pay the mortgage. So we have life insurance. So if someone did pass away, a lump sum is going to the surviving partner to clear that debt, and so the family can stay in the family home. So super important. So one is debt. The second one is income. So let's just say, for example, the main income earner in the family passes away. We've cleared the home, but what happens in terms of living expenses? So we can also factor in a large lump sum that could be invested if that person passes away to generate an income for the surviving spouse and the partner. So that's what we use life insurance for. Life insurance sometimes is through superannuation, so it's really important to actually see how much you've got and receive advice, so we can certainly help there. The second type of insurance that we can have is what's called TPD, or total and permanent disablement. Now, TPD basically is paid a lump sum in the event that you can never work again. So let's just say it was like a major car accident or something like that. You're still alive, we'd receive a lump sum. Now, the reason we use this money is effectively for 3 things. Like we just mentioned with life insurance, one is to pay the mortgage, right? You're disabled, you can't work again. We want to get rid of that debt so you don't have to then lose the family home as well. The second thing is make sure you and the family have got enough income to live for living expenses. And then the last one, which you should consider as well, is any medical expenses. So again, TPD, or total and permanent disablement insurance, can be done through your superannuation fund, so it's worthwhile checking that. But that's just to give you a bit of a guide in terms of when we put together a strategy in those terrible events, you know, what we consider. The third one is what we consider trauma insurance, or it's often called living insurance as well. And that's where someone may suffer from cancer or a stroke or a heart attack. They may not necessarily pass away. They may not be totally and permanently disabled. They may be able to return to work down the track. But let's just say, for example, you're out of work for a year or 2 with cancer. The cost for this treatment is huge. And Medicare, in many cases, and private health insurance just don't cut it. There's always a gap. So trauma insurance, again, pays a lump sum. And in this case, pays a lump sum if you survive 14 days if you suffer from one of these listed events. I've just listed a few: the heart attack, stroke, cancer, Parkinson's, all those sort of nasty ones. The fourth one to consider is what's called income protection. And this is effectively like long-term sick pay. And this pays a regular income on a monthly basis. So you can imagine if you couldn't work for a period of time, your sick pay would certainly cover it for maybe days or maybe weeks, depending on how long you've been with your employer. But what happens next? You may not get TPD because you may not be totally disabled. You may just be out for a period of time. You may not get trauma insurance because you may not have suffered a heart attack or something like that, but you're out of work for several months. So this is when income protection kicks in and pays you that regular income stream. It's just giving you peace of mind that if anything happens to you, you can continue to live using that income. The cool thing about income protection, it is a tax deduction, which is nice. And also you can have various options in terms of how much you are paid, whether it be 2 years or 5 years, for example, you can have peace of mind knowing that you'll get that regular income stream during that time. I provided a high-level overview, so it doesn't go into the full details, but at least it gives you the main points to be able to sleep at night. If you've got insurance already and you're considering cancelling it, I'd highly recommend speaking to someone and getting advice first. Or you may want it reviewed, and if your situation's changed, maybe the cover needs to be adjusted. Please reach out, we'd love to assist. Thank you.